Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about KQQQ, which comes to us from KURV ETFs. And this is an actively managed ETF, a basket of tech stocks chosen to provide both growth and income through a covered call strategy. And we're going to get to talk to Howard Chan as well. He's the founder of KURV ETFs. Find out all about this one and see if it belongs in our portfolio. If that is what you're looking for, please stick around. Whoop. So before we hear from Howard, let's jump over and get our bearings straight and take a look at KQQQ here on the KURV website. Now, if you're not familiar with KURV, I have reviewed one of their products before. I'll link that up above so you understand a little bit more about them. You can take a look at that. But they have several ETFs. That's kind of how they started to build this in similar fashion to what Yieldmax did, right? Having some individual option-based income ETFs based upon individual stocks. That's kind of how they started too. So they've got ones on Amazon, Apple, Google, Microsoft, Netflix, and Tesla. So KQQ is a little bit of a different approach as they're looking at something more broad-based but focused on the technology sector. So inception date for this product is 7/22 of 24. And the net expense ratio, which I'm always looking at, is 0.79%. But with acquired fund fees and expenses, it pushes it up to around 1%. Okay, so that's what you're going to see out there. Now, the approach that they've taken, even though it's KQQQ, which should make you think NASDAQ, is they're removing non-technology companies to gain pure exposure to the top technology growth stocks through smart security selection. So again, actively managed, and they're looking at this and trying to remove products that you find in QQQ which don't feel like they should be in there. For example, Pepsi Company, Costco, to name a couple. So they're getting rid of those, and they're really trying to focus on the tech plays, or what are considered technology companies. Also, it says dynamic optimization balance between physical and or synthetic company exposure. So not only will they be long stock, they're also going to use synthetic options and kind of mix these together. And we'll hear exactly why that is when we talk to Howard. To seek maximum growth, names are weighted based on momentum signals. It is rebalanced on a quarterly basis. And their writing covered call seeks to generate income on a stock with limited upside potential or low price momentum, which can also serve as potential downside mitigation. Again, we'll hear from Howard on this and exactly how it is. Now, this does distribute on a monthly basis like a lot of these do. So that's something that people like. And if you scroll down, we're going to see distributions again, monthly distribution rate, currently 11.77% based upon the last distribution. Okay, so it hasn't been out a full year, but I think this one's probably going to settle into that 8 to 10%, maybe a little bit higher, a little bit lower. So we'll kind of have to see. Again, it's a new fund. It has been out for less than 1 year. But you can read through the prospectus. I always urge people to do that. If they want to really put some money down into this, they should read through that and understand as much as they can about that particular ETF. And now let's take a quick look at the holdings as well. We can roll down, and we should find the holdings down here towards the bottom. We can kind of see what's there, but I'm going to download everything so I can take a closer look and see what they have in this fund. So it is actually in KQQQ, and it starts out with some United States Treasury bills. And why is that in there? Well, I'm going to let Howard explain that later in the video, but it's part of this synthetic long positions that they have within this fund. Now, Apple is a very good example of how this might be structured at times. So this Apple position, first of all, we have a long position in Apple. We just own the stock. But then we also have a synthetic position that acts as if we own additional shares, all right? So this is a call here at 205, and that would marry up. This long call would marry up with the short put here at 205. And that creates this position, this synthetic long position that acts like we own those shares as well. Then against that, they're selling calls at 220. All right, so this is part of the covered call strategy. And in a sense, their covered call strategy reminds me of DIVO, where they're selectively picking stocks to sell covered calls against when they see a lack of momentum in that stock. So they think there's not going to be growth. It's actively managed. This is a good time to sell a call and create some income for the portfolio. You're also going to see long positions in things like Amazon and Broadcom and Salesforce. And then you're going to see one here for Salesforce where there's a call again trying to collect some income with some short calls, selling calls to collect option premium. Then you're also going to see Cisco, you're going to see Google. So some of these have those synthetic long positions like Microsoft, and those are easy to pick out. Again, you're going to see a similar quantity or the same quantity. You're going to see that long call position that acts like we own the shares, and it's been married up with that short put. It's going to act like we own the shares in case it declines as well. So this really presents it like we own the stock. And those are the holdings. You can look down through here. So they also have Oracle, which has been on a tear lately, Palantir, Spotify, Tesla's part of this, Uber's part of this. So that's the selection of stocks that they've picked that are their tech plays. Stop, freeze frame. One other thing that I failed to mention is they do own 2 of their own ETFs. That is GOOP and TSLP. And why do they do that? Well, we'll hear that from Howard in just a little bit. So now let's get Howard's take on KQQQ and the portfolio construction for this ETF. Remember, they're trying to ride momentum of these tech plays that they actively select, get out of the way, let those run, and when that dies off, sell actively, covered calls to collect income.
I remember you're an engineer, so like I think you might appreciate this. So KQQQ is sort of my engineering answer to a traditional cover call ETF. And what is the problem with the traditional cover call ETF is it gives good income, but when the market rips, you always underperform, right? It caps, you trade some of your upside for your downside. So what we wanted, so, you know, we kept being asked to do these funds of cover called ETFs because some competitors have them. And we were kind of like a little bit resistant because we don't want to just like another kind of similar product. So we came to like go back to square one and we was like, okay, what would we want to put in our portfolio, right? We want, when the market is good, we want to have the upside, and the market is down, we want to have income. That's really like, that would be the best of both worlds. Can we kind of make that happen, right? So the portfolio construction process is really 3 steps, but it's kind of addressing each one of these things. The first is just finding a good basket of tech names. And tech is not like just like software, or it's any, the way we define it is any industry that uses technology to transform its vertical. So that's why Netflix is considered a tech company, right? Because essentially it's streaming, it's not, there's no. So we have like 15, 20, 25 names that's in there. And they generally are larger tech companies because we will write calls, but we want to write calls that are on things that are not going to go bankrupt in 2 months, right? That's the, you know, that's the and generally you want larger names because their option market is a little bit more liquid, right? That's part of the consideration. Like you want liquidity, you want to be able to go in, and if you want to get out, you can get out. That's the first part. So picking the names. Then the second step is, okay, if the market is going up now, how do we capture upside? And so what we do is momentum weighting. So a very, very key characteristic of growth stocks is that they generally have momentum. So if their price goes up, it would turn to go up, and then there's a pivot point where they will stop. And that cycle usually is about 9 months. That's historically around 9 months. So what we do is to capture more of the upside is when a stock has exhibited 2 months of continuous price increase, we will overweight a little bit, 2.5%. And then when it reached that 5 months continuous, we do another 2.5%. So that's why we're doing the first quarter and half of that 9-month cycle. So we don't want to wait until the end of the cycle. Then we kind of miss the momentum, right? So that's the thing. So what happens with the ones that don't have momentum, right? Not all tech stocks are going up at the same time. Sometimes they do, but like not. When the tech stock is not going up, meaning it's trading sideways or it's trading down, that's the perfect time to write cover calls. So we write cover calls, right? And then if you take it from a macro perspective, is if you have a market sell-off, let's say beginning of the year in April, all of the names don't have price momentum. Then you start writing cover calls on all of the names. And that's actually a good thing to do because when market sells off, volatility is high. And when you write the call, you get more premium than you would usually do it. So this is like very engineering, like construction kind of thing. And so the little bit of difference between our fund and other funds is that generally other funds distribution is a little bit stable. So they'll be like at 11% all the time, right? Or more or less, right? Around that. You have to have some trade-off. So our trade-off is our distribution will change within the range of 7 to 14%. Because when the market is going up, we're going to write less cover calls. We're going to let it rise. And then so at the beginning of the fund, we were distributing like 7, 8, 9% because we were writing, I think 30, 40% of the portfolio on cover calls. Those names didn't have price momentum. And then when we had Liberation Day, distribution went up to 14, which is about a NASDAQ 100% cover call is about 14%. So we raised it. So it's actually counter-cyclical. You get more income when the market is selling off. And then you get less income when the market is going up because you're having price appreciation. Bottom line is sort of when the market is rising, we get out of the way, out of momentum. And then when the market is correcting, we write higher premium cover calls for the fund.
So an interesting approach using active management within a covered call fund that's also trying to take advantage of price momentum. Now they do rebalance this one on a quarterly basis. They've got this mix, right, of long stocks, synthetic long positions, and they also own some of their own funds. For example, GOOP is currently in their portfolio. That is one of their funds. When I asked Howard about that, he started talking about tax loss harvesting, and that makes lots of sense.
So the other thing you mentioned in the beginning, why do we hold our own funds? So let me explain why. It's for tax loss harvesting in the portfolio. So for instance, if we say we want to hold Tesla in the portfolio, right? And we want to write cover calls. And this happened at the beginning where Tesla started selling off, I think, middle of December till this is like after the election pump kind of thing. So we held Tesla and there was a loss on that position. But our systematic is like, okay, it's lost momentum. You should be writing cover calls, right? So what we did was we sold the stock, we harvested the loss, and we invested into the ETF because the ETF already is writing a call. So we have that loss we've captured that can offset any other gains that's in the portfolio. So we could do the cover call in the portfolio, but if we're smart about capturing the loss, we can have a similar other exposure that we can use the ETF. So we're not egregious. There's only two that we use is Google that we use our own ETF and Tesla, those two. Because the model's like, okay, you need to write cover calls, but we had losses on those stocks. They've rebounded, but we were able to harvest the loss when they were losses, and then we put it in the cover call ETFs to do the tax loss harvesting.
Now, recently I did a video on taxes in 2024 for the different covered call funds and other income funds that I own, and I'll link that up above if you want to check that out. But I did ask Howard about return of capital when it comes to this fund. It hasn't been out for a full year, and their fiscal year ends here in about a month or so. So he doesn't have firm numbers, but he projects that the return of capital for KQQQ will be right around 95%. So pretty substantial as far as tax efficiency goes for this ETF, it looks like, for year one. And this last part that I'm going to show you now is a good explanation of the synthetic long position and just why T-bills are part of the setup for a synthetic.
Generally, when you have a synthetic long, you have to pair it up with a T-bill or a money market fund because there's an implied financing rate in the to be a full. This is actually what a lot of people don't understand is Tesla stock. In order to get a completely financially equivalent is you do a synthetic long, which is long call, short put, but there's a minus financing cost. So you have to put the collateral into a T-bill. It's the combination of the three that makes it equivalent to a stock. If you just had the options, you're actually short 4.25 every year in that. You'll underperform the stock by 4.25 because of the implied rate. So that 4.25 is interest payments because it's a T-bill. So you have to distribute that 4.25 because it's net investment income. Some of the stocks we have in the portfolio also is dividend distributing. So those dividends plus the interest income is something you have to distribute. But we can do heartbeat trades in our portfolio. So any of the gains from our option positions, we can actually move out of the portfolio. So that gets us closer to return of capital than otherwise. Yeah.
And finally, let's jump over to Seeking Alpha and take a look at performance for KQQQ since inception. Also, for those that are looking for a stock and ETF research tool, nothing is better, in my opinion, for these types of alternative ETFs than Seeking Alpha. And I am a Seeking Alpha affiliate, so there are going to be some discount codes down below if you're looking to make your own fancy charts just like this one. So anyway, this is a total return chart comparing a few of my favorite covered call ETFs that are associated with the NASDAQ. Now, KQQQ, it's only been out for about 11 months. So while they say the proof is in the pudding, the KQQQ pudding is still kind of setting up, in my humble opinion. Nevertheless, it is worth taking a look at. So since inception, KQQQ is up 9.26%. Not too bad, but that does trail the straight up QQQ by a little bit less than 1%. Now, some of my other favorites in this category are QQQI from Neos, which is up 12.26%, and GPIQ, which is up 10.84% during this same time period. Also, just to throw in one more, JEPQ comes in at a distant fourth for this period in time at 6.92%. Now, my personal approach with this has always been to build a soup bowl of the best covered call ETF. So can KQQQ make it in my soup bowl? Well, for me, it needs just a little more time, but it certainly looks promising. Now, there are periods here, such as right in here, where you kind of see it shine and when that momentum strategy looks like it could be working, but perhaps the additional volatility without some of those more stable QQQ stocks hampered it during this period in relation to QQQ when you kind of see it fall off for a period in there. But again, very short period of time. So my personal goal with these covered call ETFs is to mirror the performance of the underlying index while stripping off tax efficient income. So if you think about the combination of KQQQ, QQQI, and GPIX, if you add those three numbers together, divide by 3, you'd be making a soup bowl that averaged a 10.78% return with 3 slightly different option-based strategies during this period in time, outshining QQQ by over 0.5%. So, something to consider. So that's my look at KQQQ from KURV, this actively managed income ETF. Let me know what you think about this one down below. If you have any questions, let me know. And if you own any other KURV products, let me know that as well. I'm sure Howard would want to know. Now, if you made it this far, like and subscribe. And we'll see you with more content later. Have a great night. Take care. Whoop.